For info only, not financial advice. You're with Channel Vest. This is your analysis. Get ready, folks, because we're diving deep, deep into the world of ETFs. We're going to uncover some serious investing secrets today, and trust me, you won't believe the mistakes people are making out there.
That's right. Avoiding these common pitfalls, these blunders, it can make a huge difference in your returns. Today, we'll break down 3 major ETF investing mistakes in a way that even a beginner can understand.
Stick around because this knowledge is power.
Absolutely.
All right, so let's unpack this. We're talking about ETFs with crazy returns, right? Like some of these ETFs are seeing returns of over 17% or even close to 20% over a decade. That's insane. So you would think everyone would just pile into these high-return ETFs, right? Like, why wouldn't you?
Well, not so fast. What's fascinating here is that chasing those big numbers without actually understanding what's inside those ETFs can lead to a really common mistake, and that is fund overlap.
Fund overlap. Okay, break it down for me like I'm back in high school trying to figure out my locker combination.
All right, think of it like this. You're building the ultimate sandwich, right? You're super excited about the ingredients. So you grab a basket with all the best meats and cheeses, good stuff. Then you grab another basket labeled deluxe sandwich kit, right? You're thinking, oh, this is going to be even better. But then you open it up and guess what? It's the same meats and cheeses you already have.
Oh, no. Not the same stuff.
Exactly. That's fund overlap. Some ETFs, especially those focused on similar sectors, might hold many of the same companies. So you end up paying for the same thing, twice.
So is fund overlap always a bad thing? Like, what if I want extra cheese on my sandwich? Is that okay?
That's a great question. It all comes down to your strategy, right? If you're deliberately overweight in a particular company because you believe in its growth potential, then having it in multiple ETFs might be part of your plan. But if you're aiming for broad diversification and accidentally end up with, say, half of your portfolio concentrated in just a few companies, well, that's a problem. You're not as diversified as you think you are.
You're with Channel Vest. This is your analysis. Makes total sense. Okay, so what's the next investing trap we need to watch out for?
This one might surprise you. It's the age-old idea of diversification at all costs.
Wait, are you saying diversification is dead?
Hold on. Don't panic. Diversification is still important.
Yeah.
But blindly spreading your investments across every single asset class might not be the best path to success.
You won't believe this. So what are you saying?
It's about finding the sweet spot, right? The balance between diversification and focusing on areas with strong growth potential. You wouldn't put all your eggs in one basket, right?
Right.
But you also wouldn't spread them out so thin that none of them hatch. You got to find that balance.
You're with Channel Vest. This is your analysis.
Yeah.
Okay, my brain is officially doing backflips. This is insane. So we've talked about fund overlap. We've talked about diversifying the right way.
Yeah.
What's the most mind-blowing mistake people make with ETFs?
Drum roll, please. The biggest mistake is blindly following someone else's investment strategy without understanding your own goals and risk tolerance.
Okay, that makes sense. But how do I figure out what's right for me?
That's where the real work begins. Do your research. Don't just chase returns. Understand what's in those ETFs you're considering. Figure out if they align with your goals. And most importantly, know your own risk tolerance.
That's a powerful takeaway. But hold on, there's more to this story, right? We can't just change our entire portfolio every time we learn something new. We need a plan. Stick around.
You got it. One investor might be all about high growth, while another might be focused on generating income. Your portfolio should reflect your unique circumstances. For example, let's talk about REITs. Those are real estate investment trusts, and they're popular for generating passive income. But someone who already owns a bunch of rental properties, right, they might want to limit their exposure to REITs because they already have a big chunk of their portfolio in real estate, and adding more REITs could make them, too concentrated in one area. It all comes down to understanding your individual goals and risk tolerance.
Mind blown.
So you're saying just because something like REITs sounds good doesn't mean it's the right fit for everyone.
Exactly. It's not a one-size-fits-all situation. Yeah. Think of it like this. You wouldn't wear someone else's eyeglasses, would you? Your investment portfolio, it should be just as personalized.
You're with Channel Vest. This is your analysis. This is game-changing stuff. I'm starting to see the light here. But how do I know if I'm making these mistakes right now? What are some red flags to watch out for?
Great question. Here's a quick checklist for you. Red flag number 1. You're chasing the hottest ETFs without really understanding what's inside them. You see those sky-high returns, and you jump on the bandwagon without even considering the underlying holdings or how they fit into your, overall strategy. Does that sound familiar?
Oof, guilty as charged. I've definitely fallen into that trap before. It's like ordering a fancy cocktail without knowing what's in it and then realizing you hate gin. Yeah, exactly. Red flag number 2, you're spreading your investments too thin. You're trying to have a piece of every single asset class, under the sun. And you might think you're diversifying, but you could actually be hurting your returns by diluting your exposure to those higher growth areas.
Okay, so we need to find that balance, right?
Yeah.
Not too concentrated, but not too spread out either.
Hmm.
Makes sense. You're with Channel Vest. This is your analysis. All right, what's the third red flag?
Yeah.
The one that makes investors, break out in a cold sweat.
This one's a biggie. Red flag number 3. You're blindly copying someone else's investment strategy without even considering your own unique circumstances. Maybe you're following a guru's recommendations or trying to mirror a friend's portfolio, but you haven't taken the time to really understand, your own financial goals and risk tolerance. This is where things can get really dangerous.
You won't believe it. It's like wearing someone else's shoes. They might look great on them, but they'll give you blisters.
Exactly. And those blisters, those can translate into serious financial pain down the road.
You're with Channel Vest. This is your analysis. Okay, so how do we dodge these pitfalls? Spill the tea. Give us the insider secrets.
Well, the first step is awareness, right? Recognize that these mistakes exist and be honest with yourself about, whether you might be falling into any of these traps.
Okay, so once we've, acknowledged our potential blunders, what's next?
Take control. You are the architect of your financial future. Don't let anyone else dictate, your investment choices. Take the time to understand your goals, your risk tolerance, and the specific ETFs you're considering.
So basically, do your homework. Don't just follow the hype. Think for yourself.
Precisely. You wouldn't buy a car without researching its features, safety ratings, fuel efficiency, right? Investing deserves the same level of careful consideration.
Okay, I'm starting to get the picture. You're with Channel Vest. This is your analysis. But there's still one piece of the puzzle missing. How do we actually choose the right ETFs for our portfolio?
That's where things get really interesting. There are thousands of ETFs out there, each with its own unique investment strategy, risk profile, and costs. The key is to select ETFs that align with your individual goals and risk tolerance.
Okay, no pressure or anything, but how do we actually do that?
First, define your investment goals. What are you hoping to achieve with your investments? Are you saving for retirement? A down payment on a house? Your child's education?
Got it. So we need to know our destination before we can chart a course.
Exactly. Once you know your goals, you can start thinking about your time horizon. How long do you have to invest? The longer your time horizon, the more risk you can, generally afford to take.
Interesting. So if I'm investing for retirement, 30 years from now, I can be a little bolder with my choices than someone who needs that money in 5 years. Right?
Precisely. And this brings us to the next crucial element, risk tolerance. How comfortable are you with the possibility of your investments, losing value? Some investors, they're willing to stomach wild swings in the market for the potential of higher returns, while others, prioritize stability and predictability.
That makes sense. Some people are adrenaline junkies while others prefer a smooth ride.
Yeah.
So we've got our goals, our time horizon, and our risk tolerance, all figured out. You're with Channel Vest. This is your analysis. Now what? How do we actually narrow down the universe of ETFs and, choose the winners?
That's where research comes in. You need to dig deep into the specific ETFs you're considering, look beyond those flashy total returns, and examine, the underlying holdings, expense ratios, and historical performance.
Okay, time to put on our detective hats. What kind of clues should we be looking for? What makes a good ETF versus a bad one?
Well, one of the most important factors is the expense ratio. This is the annual fee you pay to the ETF provider, for managing the fund. Even a small difference in those expense ratios can really make a big impact on your returns over time.
So we're looking for ETFs with low expense ratios.
Got it.
What else should we be paying attention to?
You also want to consider the ETF's tracking error. This measures how closely the ETF's returns track the performance of its underlying index or benchmark. A low tracking error indicates that the ETF is doing a good job of, replicating the performance of its target investment.
You're with Channel Vest. This is your analysis. Stick around because we're about to reveal the ultimate secret to choosing the right ETFs for your portfolio.
And don't forget to look at the ETF's trading volume. A higher trading volume, generally means you can buy and sell shares more easily without, significantly impacting the price.
Okay, this is making a lot more sense now. You're with Channel Vest. This is your analysis. It's like we're peeling back the layers of the onion, like revealing the secrets of the ETF universe.
Exactly. And remember, building a successful ETF portfolio is a marathon, not a sprint, right?
Hmm.
It requires patience, discipline, and a willingness to stay informed. Don't get discouraged if you don't see immediate results. Stay focused on your long-term goals, and you'll be well on your way to achieving, financial success.
You're with Channel Vest. This is your analysis.
Mm.
That's some powerful advice. It's not just about picking the right ETFs. It's about having the right mindset, right?
Absolutely. Investing is as much about psychology as it is about numbers. It's about understanding your own biases, managing your emotions, and staying disciplined even when the market throws, curveballs your way.
Okay, so we've uncovered three huge ETF mistakes that could be holding you back. Blindly chasing returns and creating fund overlap, over-diversifying without considering returns, and copying someone else's strategy without understanding your own goals. Mind blown. What stands out to you from all this? What will you do differently with your investments? Let us know in the comments. And while you're at it, hit that subscribe button to catch more deep dives into the world of finance and investing.
And remember, this is just the beginning. Keep learning, keep questioning, and keep building a portfolio that reflects your individual goals and risk tolerance.
You're with your Channel Vest. This is your analysis. See you in the next deep dive. Don't forget to subscribe and leave us a comment below.